You just realized your retirement account is short by 6 figures. Now what? You're in the right place. In this video, we'll quantify your exact gap and show you the 5% fix. Small shifts that close a $250,000 shortfall without blowing up your lifestyle. We'll model two real scenarios, a conservative saver and a late starter, and identify the key changes that make a real difference. Stay with me to see how a 5% increase in savings, an 18-month delay, or a smarter allocation can change your trajectory in minutes, not years. First, let's run a quick check to size your gap, so we're working with real numbers. Quantify your gap in 5 minutes. Let's keep it simple and get your number fast. Quantify your gap in 5 minutes. What if your 6-figure shortfall isn't a cliff, but a math problem with 3 inputs you can control? Start with a quick diagnostic. You need 3 numbers: your target retirement income per year, the assets you already have working for you, and the years left until you want to retire. We're not locking in any decisions yet. We're getting a baseline so you don't overreact or underreact. In 5 minutes, you'll know whether you're off by tens of thousands or a lot more. General rules like 25 times your expenses can be a rough starting point, but they often overlook specifics like Social Security, pensions, your risk comfort, and timing. For some people, that rule inflates the target and makes progress feel impossible. For others, it understates the need and invites coasting. Small tweaks to the inputs can swing the result by hundreds of thousands, so it's worth doing the quick math. Here's the clear method. Estimate what you plan to spend annually in retirement. Subtract guaranteed income you expect, like Social Security and any pensions. The difference is the annual gap your portfolio must cover. Then apply a conservative withdrawal rate, often cited around 3% to 4% as a rule of thumb, not a promise, to estimate the capital required. Example. Say you plan to spend $80,000 and your projected Social Security is $35,000. That leaves a $45,000 annual gap. Using a 4% rule of thumb withdrawal rate, you'd target roughly $1.1 million in invested assets to fund that gap. It's a hypothetical meant to size the ballpark. Now contrast that target with your current path. Look at today's balance, what you contribute each year, and a reasonable after-inflation return. You don't need a spreadsheet here, just a conservative lens, so you're not banking on perfect markets. For instance, someone around 50 with mid-6-figure savings and steady contributions might project to land near high 6 figures by their late 60s. If the target is about $1.1 million and the path points to roughly $850,000 to $900,000, that's a gap of around $200,000 to $300,000. That's the number you're solving. The key insight is that small levers move big numbers. A modest adjustment to savings, timing, fees, or allocation compounds quietly for years. You don't need heroics. You need precision. Now that you have a dollar gap, let's test the simplest lever first. Can a small bump in savings make a meaningful dent without touching your lifestyle? Scenario 1. The 5% fix for the conservative saver. Meet Alex, a hypothetical conservative saver. Age 50, about mid-6 figures invested, contributing around 10% on a solid salary, sitting in a balanced 60-40 portfolio, aiming to retire at 67. Using the gap method, Alex is short roughly $250,000. The sticking point isn't discipline, it's room in the budget. Raises are modest, and big lifestyle cuts feel unrealistic. So the real question is whether a small increase does anything you can feel, or if it's just noise. Here's the lever. Move from 10% to 15% savings. That's turning up a dial that already exists, not rebuilding the plan. Contributions then rise as pay grows, so the extra dollars scale without fresh decisions. The math matters less than the mechanism. More going in earlier gives compounding more to work with for more years. Let's model it at a high level. Keep assumptions conservative, steady contributions, reasonable after-inflation returns, and the same overall risk mix. Compare the current path with the plus 5% path over the next 17 years. The difference builds gradually. Every extra deposit adds new principal and extends the compounding runway. The gap between the two paths widens over time, Not because of a fancy trick, but because consistency compounds. If cash flow feels tight, use low-friction sources. If available, direct a slice of any raise, overtime, or small bonus toward the extra 5%. If those aren't in the picture, consider shifting a few discretionary line items or phasing in the increase by 1% every few months until you reach the full 5%. Automate it in payroll so it happens before money hits checking. The goal is to remove willpower from the equation. Add simple guardrails. Keep your risk level steady and look for ways to reduce investment costs where you can. Broad index funds, low-fee target date or balanced index options, and auto-rebalance. Lower ongoing fees act like a quiet boost to net returns over many years without taking on more risk. Stacked together, a modest savings bump plus lower drag can materially shrink a six-figure gap. For many conservative savers, that gets most of the distance and leaves a smaller remainder to handle, with routine catch-ups or a bit more time. Which raises the next question. If turning one dial helps, what happens when you combine a few simple levers? Scenario 2. Late starter, smart allocation, 18-month delay. Let's look at a different profile where timing and allocation do more of the work. Meet Bri, a hypothetical late starter. Around 50, mid-six figures or less invested, contributing under 10% on a mid-income salary, holding a roughly balanced stock-bond mix, hoping to retire at 65. Her gap is about $250,000. The numbers feel heavy, and the timing feels tight. Rent and kids' expenses are real. A sudden big jump in contributions isn't happening next paycheck. So we're going to look for low-friction moves that still shift the outcome. First lever, push retirement out by 18 months. It sounds small, but it does three things at once. You add a year and a half of contributions. You shorten the years you need the portfolio to cover, which reduces the capital required. And Social Security is likely higher when claimed later. Without getting lost in formulas, waiting beyond early claiming generally raises the monthly benefit, and claiming at or after full retirement age can increase it further through delayed credits. A larger check reduces the draw your portfolio has to support. Second lever, make the allocation more resilient. Glide from a growth-tilted mix toward a slightly more balanced stance as retirement nears. Not to get timid, but to reduce sequence risk. Use broad, low-cost index funds and turn on auto-rebalance so the target stays intact. This helps Bri participate in growth while trimming the chance that a late bear market does outsized damage. Many age-based or target date approaches follow a similar path, which keeps this simple and research-aligned in spirit. Let's frame the stack conservatively. With an extra 18 months, Bri adds contributions and lets existing savings compound longer. Helpful, but not a guarantee. The higher Social Security benefit lowers the annual withdrawal need, which eases pressure on the portfolio. Layer in a small, steady behavior change. Auto-escalate contributions by around 1% once or twice a year until she's up a few points. It nudges savings higher without a sudden hit to cash flow, and catch-up contributions at age 50 plus can help fill tax-advantage space if available. Together, modest delay, auto-escalation, and a cleaner allocation, Bri can materially cut a six-figure gap with minimal lifestyle change. Small, deliberate moves like these are practical to automate and don't demand perfection. Here's where it comes together. Run your 5-minute gap number today. Then act on the two clearest levers we covered. Raise savings a notch and give time a little help if you can. That turns panic into a plan, and a plan brings calm because you know what to do next. Small changes, applied consistently, compound into real progress. If this clear, numbers-first approach helped, tap like and subscribe for more insightful videos coming your way.